They're broke. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, Wendy's issues a grim warning. And as you're about to see, this is an ominous sign for the U.S. economy and has everything to do with why stocks are selling off. Now, let's head over to Bloomberg, where we picked today's story up with a headline, as Wendy's cuts sales guidance as U.S. guest count drops. As we're about to see, U.S. consumers are indeed going broke, and Wendy's is just the latest in the fast food chains to tell us that traffic is headed down along with sales. Overall sales should increase between 3 to 5%. Now keep in mind, inflation's running at 3%, so that suggests near zero growth, down from an earlier forecast as much as 6%. In the second quarter alone, sales out locations open at least 15 months grew slower than analysts expected, and revenue also fell short. The company said that customer accounts declined in the U.S. in the period, which is partially offset by bigger order values. So what we're seeing here is effects of higher prices in an economy where workers and consumers cannot afford them. Those who can are paying more. Those who can't aren't shopping at all, heading home to eat. And this is just an indication of what's happening in the broad economy that's leading to a massive slowdown. Wendy's sales growth had moderated in recent quarters, weighed down in part by the demand slump affecting quick service restaurants. It also hit McDonald's, Starbucks. We can name Burger King and Taco Bell, and many companies are saying that consumers are indeed trading down. They're looking for value, and many people just aren't even showing up anymore because they can't afford it. And we've got some charts that will pretty much explain everything you're seeing here, because now we know the stock market is heading down today, but this again is an ominous sign for the broad economy. But one thing that's heading up, that is our trading accounts for our subscribers. Let me show you our top open trade for CTA Timer Pro. As of close of business yesterday, we're up 17.19%, despite the fact the equity market's been down since mid-July. Now, how do we do that? Well, the CTA Timer Pro, we beat the machines. We look at machine positioning every day across broad equity, bond, and commodity markets, and we look for when the machines are deep short and prices moving against them, meaning they've got a short cover, and that's our indication to buy. But maybe you like to trade the technicals. Here's a trade going back to June that's still on the books. Our Dow Jones trade is up 4.29%, and again, the market's heading lower, but the Dow's holding up as well as our subscribers. And how do we trade momentum? Well, we look at it over longer periods. We take things like the RSI, the MACD, and other technical indicators, smooth them out with a proprietary overlay, and look at them at long periods. And here you see a monthly pullback, and when we see a switch in momentum, that flags our report. Here's the best part. You get the daily report. You get the tradable signals. I go through all of them, give you my opinion on them. We give you stop loss levels. We track them and show you the returns. You can duplicate. That's the best part. We give you the weekly update on the stop loss levels and a 30-day free trial. But we tell you exactly when to buy, what to put your stops at. You can duplicate every single trader we have. You pick the ones you want. We tell you which ones we think. But let's talk about what's going on in the fast food place, because you notice everything to do with the fact that consumers cannot afford higher prices. And here we're looking at advanced retail sales for retail trade and food services in red against total compensation for non-supervisory employees. This is looking at average hourly earnings multiplied by average weekly hours. They're both showing on a year-over-year rate of change. And what I want you to see is at periods like now where you notice the total compensation growth is slowing, meaning workers aren't getting as big of raises. They're seeing their hours work decline. And look what happens. People eat out less. And you see that almost instant reaction. We can go back here around 2010. We see total compensation growth slow. At first, it didn't have an impact. And then next day, you know, it did see demand decline in fast food stores. And it happened again going backwards here to the global financial crisis, the dot-com bubble, and back in kind of the early to mid 90s. And what we note now is this trend typically indicates a recession. Now, maybe we didn't have one in 2012, 2013, but we almost did. And here we can see it's affecting, of course, businesses all around the country and the world, as Intel now to cut thousands of jobs to reduce cost. We'll get to final details on this shortly, but look at this. Intel reduced its workforce about 5% last year, and that, well, we're seeing a change now again, because what happened is companies cut headcount. They thought, okay, we overhired. We're about to experience a soft landing that the Federal Reserve told us we're going to see. Now they're realizing we're not seeing the soft landing at all. Demand's going down. And that's where we look at companies like Wendy's and McDonald's, Taco Bell, Burger King, and so forth, because it tells us the pulse of the consumer. When they're eating out less, when they're trading down at Walmart and other stores, it indicates that demand is declining. And we see that at Intel here too. The company expected the cost reductions would save as much as $10 billion by 2025, looking for another round of job cuts. But even we can see it in simple things like candy, as Hershey cuts outlook as consumers pull back on pricier candy. Of course, they can't afford those higher prices, and that means demand goes down, as well as inflation. And that's the key part here, because many people believe inflation is just going to continue to skyrocket higher. I'm going to give you some very convincing evidence that the Fed's got this wrong. Inflation's about to come down, and as the market is pricing in today, there's a reason stocks are selling off, because now they believe the Fed's got it wrong, and we're going to see 3 rate cuts by the end of the year. And record high cocoa prices have hit Hershey's margins and forced the company to raise their prices further. And this is what we're seeing in the data. The companies are being forced to raise prices. And this is the concern that consumers have, is that we're going to see this big increase in prices. The issue here is if consumers don't buy them, then it doesn't actually matter. Companies can raise their prices, but at some point they're going to have to discount to move things off the shelf. And this is even happening as consumers cut down on brand name purchases at the supermarket. The company said that margins fell, and this is what's going to happen as you start to see disinflation come back. Fell on higher commodity costs, offsetting productivity improvements and higher prices, indicating that there's just no way they can avoid passing these higher prices on, except for the fact that consumers can't afford them. And it's very evident that what happens here, we turn to the labor market, and this is why the stock market's having such a bad reaction today. We're going to look at more details of this, but I want to give you the chart perspective first, because when we look at total compensation growth, still shown in blue on a year-over-year rate of change, as again workers see their pay increases decrease, their hours worked get cut, what it means is there isn't enough work for them, and eventually employees get sent to the unemployment line. And the problem is, if the economy doesn't have enough jobs to absorb them, they get stuck on unemployment. And here you see continued unemployment claims in red that continues to rise against a decrease in total compensation growth. And we see this trend happen commonly heading right into recessions here at the dot-com bubble. Here you see it again, the global financial crisis, and you see this trend now. And I've noted the big concern I have, and I've even mentioned this to our subscribers, is the concern here is a rising trend in unemployment. This is actually terrible news for the equity market that's looking for that soft landing narrative. The belief here, of course, is, well, if things slow down a little bit, the Fed will just put in a couple cuts and everything will be fine, unless, of course, we start to see indicators where the U.S. economy, particularly the labor market, is about to fall off a cliff, and we got some of that evidence today. As U.S. initial jobless claims rise on one-year high now as hiring slows, this is exactly what we predicted would happen. First, you see prices go up. You don't see wages go up enough for consumers to afford them. Demand starts to go down. You see businesses still forcing a little bit like Hershey's to raise prices, but still noting that their demand is going down. Next thing you know, as demand falls, hours worked get cut. You see wage increases slow, and next thing you know, workers hitting the unemployment line with no opportunity. And indeed, that's what we find out today, as initial claims increased by 14,000 to 249 in the week ending July 27. How about this? Continuing claims. And this is a key one, because if this goes up, I'm going to show you, Initial claims will follow. This is a proxy for the number of people receiving unemployment benefits, which also rose to 1.88 million. And this is getting close to that 2 million mark. But of course, the author of this article notes that, well, there's seasonal issues here. There's some other factors here. And as soon as school goes back into session, this is all going to get fixed. And of course, that's the hope, that all of this is transitory. The issue is it's structural, as you're about to see. And you can note where continued claims go, initial claims follow, as we look at continued unemployment claims in blue against initial claims shown in red. And you can see that as people hit the unemployment line and stay there, what happens is their spending power decreases because their income goes down. And of course, typically going into recessions, we're having high interest rates, which means high debt service costs. We're dealing with higher prices, and in this case recently, higher energy costs, higher insurance costs, which means consumers don't have the budget to spend on the discretionary side of the economy. That's where we start to see the layoffs happen. And next thing you know, what happens in red, you see those initial claims start to follow continued claims higher until it spirals out of control. Now we're getting some early signs that initial claims are indeed moving up, and that is going to continue to put upward pressure on continued claims until everything falls apart. And yet, Federal Reserve Chair Jerome Powell said on Wednesday that there are increasing risks to the labor market, which we've been warning about for months now, noting that job growth has moderated and the unemployment rate has moved up. But the jobless rate remains below its historical low, and data from the first half isn't signaling a weak economy. He just can't see the real-time data. He's looking backwards in his rearview mirror, and he says, well, everything looks okay, and it always is, until it doesn't. And he said this, of course, at yesterday's press conference, indicating that the Fed is only going to lower rates when they see a problem, and they don't see one yet, which is now why today the market started pricing in 3 rate cuts based on today's data of continued unemployment claims, initial claims, as we're going to look at what's going on in the factory sector as well. But summer job cuts remain low, which is typically to be expected based on the latest data from executive coaching firm Challenger Gray and Christmas, as they announced 25,885 layoffs in July, up 9% from a year earlier. And outside the manufacturing sector, which we're going to look at and is very critical, most industries remain below last year's levels. However, they did note hiring plans announced so far this year are the lowest since 2012, indicating, of course, companies do not want to hire, suggesting that if people lose their job and go on unemployment, they have no options because employers aren't looking to hire. But we do have some evidence inflation is coming down. We got that today. A separate U.S. data on today showed worker productivity increased in the second quarter by more than forecast, helping temper growth in labor costs. And Treasury yields fell while futures remained higher until the market opened, and yields fell further and stocks pummeled throughout the day. But here's the issue. When you have, say, 3 employees and one of them loses their job, the other 2 naturally become more productive. And that's key because it means less money being spent on employees, more productivity from those you have. That brings inflation down. And here you can see non-farm business sectors. We look at labor productivity in blue. This is in the form of output per hour against the consumer price index in red. That's shown on the year-over-year rate of change. And you can see all the way back into the 1940s when productivity goes up, inflation comes down each and every time. You can go back. There isn't an instance where this doesn't happen. Right now we see productivity up. We're looking at inflation pointing right down toward its 2% target. And you can see from a business perspective, as we look at unit labor costs, which of course come down as you lay off employees, and you can look at the relationship this has with the consumer price index, because as employees have less money to spend, well, that means inflation comes down because demand comes down. Here you can see that blue line of unit labor costs pointing the direction of where inflation is soon to follow. And again, you start to get the perspective of why the market's getting concerned here, because they're now pricing in, again, 3 rate cuts by the end of the year, indicating the Fed got this wrong. Of course, if we have an all-out disaster in the labor market, well, then you'll see stocks come down, which is also potentially why they're in the red today. But the bigger reason is everything, not just to do with the labor market, but what the manufacturing sector is saying about the U.S. economy. As new orders now decrease for the first time in 3 months. This is from the S&P Global U.S. Manufacturing Purchasing Managers Index, and this is not good news. Central to the worsening of overall business conditions was the first reduction in new orders for 3 months. New business decreased solidly and at the fastest pace since 2024. So if you're looking for that soft landing narrative, S&P Global is saying you're not going to find it in the U.S. factory sector here, because all of a sudden demand just fell off a cliff. It was almost as if factories started ramping up production in hopes for a second half rebound, and then found out there wasn't one at all. Firms reported a general slowdown with market demand, with clients often reluctant to commit to new projects at the current time. And they do that, of course, when they're not confident about the economy. And continued increases in production at a time of falling new orders meant that firms were able to work through outstanding business again in July. The rate of depletion and backlogs of work was solid, and the fastest in 3 months, indicating there isn't a whole lot of new orders to back up all the employees. Once they again get through those backlogs, it's game over. Hours worked are going to get slashed, headcounts are going to get dropped, and you watch, because now let's turn to the ISM. You had nothing better to say. As we look at their manufacturing PMI now in contraction again at 46.8, suggesting things for the U.S. manufacturing sector are getting worse. But let's take a look at the details here, because when we look at new order growth, we see it's been contracting for the last 4 months and contracting at a faster rate. So that means demand from wholesalers and retailers is going down, which makes perfect sense, because they only order when they need inventory or they feel their inventory levels are too low. In this case, demand isn't there, so there's no reason to put in orders. That puts that into contraction, which means as we come back to backlogs here, you can see this has been contracting for 22 straight months, and it's at the same rate it did before. But it only makes you wonder, after how many years will there be no backlogs left? Well, we'll find out, I think, in the months to come. But we look at prices going up. We see that with Hershey saying, hey, look, we're being forced to raise prices. But what we're seeing is prices go up, new order demand goes down, backlogs get worked through, and then lo and behold, what do we find in the employment sector? Further contraction now for the second straight month at 43.4. Again, remember, you see these numbers under 50, it means it's not in the right direction. So what we're finding out is the manufacturing sector is laying off. So what Wendy's is telling us about demand going down has everything to do with the labor market, which is just validating demand is dropping, and that means jobs are going to go too. And here we can validate that as we look at manufacturers' new orders in blue. That's shown on a year-over-year rate of change against continued unemployment claims. So as we see in the ISM book, new orders go down. Well, that means backlogs are soon to be gone. And next thing you know, once there's no work left, well, that means workers hit the unemployment line. And with no job opportunities out there, they're going to get stuck on unemployment. Their spending will drop. And that means demand will further fall. And next thing you know, we're going to find ourselves right into the next recession. You can see the data here validating new order growth in the negative against continued unemployment claims heading higher, and why many people are hoping the back to school season will fix what's going on with the labor market. Based on what we're seeing in the manufacturing sector and what companies like Wendy's are telling us, it's game over. It's only now a matter of time before the U.S. economy is in a recession, and with the banks in bad shape, it means we're headed for another financial crisis. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.